Got a great show lined up for you guys today. Numerous things to dive into. Obviously, we're going to go back over the fiscal cliff and what that means for real estate. We're also going to talk about the CFPB ruling, which could have a major impact on mortgages moving forward. Actually, the start of the rule is supposed to be implemented in January of 2014. We'll let you know what that means for mortgages. We're also going to give you this week's credit tip of the week to make sure that your credit is lined up, whether you're trying to obtain an auto loan, a mortgage, credit card, whatever it may be, to keep your interest rates lower and your credit scores higher. Joining me on our panel today to discuss the many issues and let you know what's on deck this week that can affect you and your real estate decisions is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Louis, how you doing today, buddy?
I'm doing grand. How are you, Ryan?
I'm doing well, sir. So obviously there wasn't too much that went on in the markets last week. We discussed at length kind of what Bernanke and the Fed minutes came out in December. That was early last Monday that we spoke, and as the week went on, interest rates, they were starting to slide a little bit. Obviously, there's uncertainty in Wall Street that the Fed could potentially be cutting off QE at some point. Now, you and I discussed that we really think that there's no way that this can possibly happen, but it's the Fed is leading us down that path of trying to rally the troops and make everybody feel like we're turning the corner here, by putting that type of language out there that says that at some point they're going to cut funds off. Well, I mean, they have an unlimited checkbook, so what does it really matter? You know what I mean? And what are your thoughts? Obviously, we saw mortgage interest rates had ticked back up. Late last week, the 10-year bond pulled back, or else it could have been a technical indicator that interest rates were going to rise pretty dramatically, but they pulled back. And I think that this is they're falling back into the pattern of, an overreaction to the market. What do you think's taking place with the Fed, and do you think that things are going to continue the way they are, get better, get worse? What are your views?
Well, Ryan, I think what the Fed does is the most important thing. Unfortunately, that's what drives the market, what the Fed does. However, secondarily, what the Fed says also drives the market, but that's short term. So the Fed, came out and they try to talk the market down a bit and say that we're not going to do QE3 anymore, possibly, by the end of the year. And even that was tempered with, not all members agreed with that. So I think people will start to realize that the Fed really doesn't have a way out of this. They're going to continue to print. All the economies of the Western world and Japan are printing. So they'll continue to do it. And what's already set in the reality, that is what's going to happen. Gold prices and silver prices and, the interest rates, they all kind of sold off when the Fed released its minutes. They've all bounced back.
Yeah, I tend to agree with you, and I think it's going to be obviously this week is a pretty big week. We have a lot of events on deck, starting with Bernanke speaking today at 4:30. It'll be interesting to see what specifically he says and if he makes notes back to the minutes. And
you could bet he will, right, Ryan?
He absolutely will. And is he going to continue to talk about contracting that accommodative policy that they've had? If they continue to do that, I would say that the stock market, and Wall Street, they're going to tend to get a little bit leery of what's going on. They might start pulling more money back out of bonds, which could make interest rates rise more. Now, once that happens, the Fed knows that one of the only driving forces that we do have, the only positive light that we have in the market is real estate, and it's due to their, artificial manipulation of interest rates. So it's almost like, I feel like that they're trying to indicate that we're turning the corner economically, but really we're not. And at the same time, they're going to be pulling the strings to make sure that interest rates do stay low. So, it's kind of crazy because we're almost talking in circles here, but the end result, I think, is much of the stuff of housing interest rates is going to stay the same.
It has to stay the same. That's their game.
Yeah, it has to stay the same. I mean, they don't want to see an all-out depression. I think it's interesting.
Excuse me. What they don't want, though, is they don't want there to be a growing awareness that the Fed is going to continue to print and to keep interest rates low, because that underlies undermines faith in the dollar, and that's what they're concerned about. So as long as the other countries are continuing to debase and the U.S. looks like it has some restraint, at least on the horizon, then they feel like they've done their job, and then they can go back to printing.
Yeah, I mean, you look at it if you're another country or even over there in Europe where they're having issues themselves, but they're looking at the United States saying, "Wow, I wonder why the Fed is just all of a sudden decided that they're going to start pulling back on their policies a little bit. Are they really getting their stuff together?"
Yeah, the U.S. doesn't want to win the race to debase; they want to be part of it, and they want to head fake some of the other countries. They all work together, all the central banks anyway.
Absolutely. It's all hand in hand. And for people out there that are thinking about whether they should purchase a home, or refinance their mortgage because they're worried about where interest rates are going. We discussed this, week in and week out that, you have to tend to look at things. So where are you at right now? Don't worry about what's going to happen tomorrow. Trying to forecast interest rates and then where real estate's going to head can be a dangerous thing. Interest rates have been at extremely low levels for an extended period of time at this point. I don't think holding out for an extra 1/8 or 1/4% makes much sense. I think you have a lot more to lose. So, if you're thinking that, hey, I'm going to wait 6 months from now, I may be able to get a little bit better interest rate or whatever the case may be, I think that you should, take advantage of the fact that right now where interest rates are at. Much can happen in the markets that is out of your control. We have the looming fiscal cliff talks, which David Blitzen, who's the managing director of the S&P Index Committee, was interviewed, and he had mentioned that they were asking him, what's one of the things that could derail the housing market, because he felt that, as a percentage of GDP, real estate, we had GDP is somewhere around 2.5% or something like that, but he was saying that the real estate portion of that GDP is 4 times what it's normally been due to rising housing starts and just more of a demand for housing at this point to take advantage of low interest rates. So he says the one thing that can actually really derail that is if fiscal cliff, if they don't actually deal with it. And right now, I mean, obviously it's just the political banter back and forth. The Republicans are saying that, they're going to hold the president to, on spending. They're going to take a hard line with Obama on spending. They're not going to let them do anything. Now, whether they can actually keep that united front and potentially face shutting down the government, which, Louis, you and I both know that's not going to happen. Somebody's going to have to cave at some point in time because their paychecks are at stake
on its debt. We talked about this last time the fiscal cliff came up. What they do is they threaten the public with, if they don't raise the debt ceiling, old ladies are going to die, the government's going to get shut down, people won't get paid, and then we won't be able to pay our debt, and then we'll get downgraded. But really, if they really wanted to just avoid the downgrade in the essential services, they can earmark the money to pay the debt, and they can cut the other spending that's not necessary. But what they do is they claim that the whole package of spending, all $1.5 trillion in the budget, cannot absolutely be touched. And in fact, we need a little more money, so we have to raise the debt ceiling. And everyone knows that that's not true, that every last dollar in the $1.5 trillion budget is absolutely essential. It's not. They can easily cut a lot of things that pretty much 99% of the people would agree on can be cut. The wasteful spending, some of the overseas spending can be cut. What they do is each politician, they don't understand economics, so they know how to get elected. They protect their own spending. And they all do it, and then they have to raise the debt ceiling. So it's a farce because they all have an interest in raising the debt ceiling. The Republicans just want to talk a big game to make it look like they're trying to cut spending. But spending has never been cut, whether you have Republicans or Democrats. It's grown every year for the last 50, 80, 100 years.
Yeah, and it's ironic because they could sit here and talk about, we're raising taxes over here, but basic math says just because you raise taxes on one side, but you're not cutting something on the other, you're never going to get ahead. And it's crazy to think that in any plan that they come up with, these people are political gurus. They're not business people. You know what I mean? And it's
it helps them not to be.
And it does. It does.
If they understood economics, they wouldn't do what they're doing.
I mean, I agree wholeheartedly, and it's frustrating to me because it's like, you sit here and you listen to all the media that's out there, and they talk back and forth about, the fiscal cliff and the Fed, and the bottom line is that they're all in it together. I mean, nobody has the public's best interest at hand here. The people that are going to benefit, the rich are going to continue to get richer. The banks are going to continue to get stronger and stronger. They're all in this mission together.
Special interests as well.
Absolutely. I mean, we're talking about all these they call them loopholes in the special interest money that's out there. That's for, like we discussed last week, what was for NASCAR and for Goldman Sachs. I mean, there's
algae growers. I mean, there's so many billions and billions of dollars that they're going to basically get subsidized tax-wise. My favorite is the Cowboy Poetry Festival.
I mean, it really, when you look into in depth at some of these things, it's just laughable. It's like,
those are the things you can cut. The only people that want some of these things like Cowboy Poetry Festivals and algae subsidies are people that are involved in them, which is, you talk about, they worry about the 1%. Less than 1/10 of 1/10 of 1/10 of 1/10% is involved in the Cowboy Poetry Festival. Now, you say those things aren't a lot of money, but you add them all up, there's thousands of those types of programs out there.
Yeah, and I mean,
they can be cut very easily, and no one would really complain. The public would not be up in arms.
But not only that, Lewis. I mean, how is it fair that they're afforded that money when thousands and thousands, millions and millions of small businesses across this country, they need funds, they need subsidies, they can't get anything, they can't get loans, they can't grow their business.
Nor should they. The government shouldn't be subsidizing different businesses and picking winners and losing and taking the money from one segment of the population or from individuals and giving it to another just because they've got a person in Congress who's voting for it.
Absolutely, and it's, but you know what? It puts that bad taste in people's mouth because they start to say, well, how come they got something and I'm not getting anything? You know what I mean? Nobody really should get anything. Everybody should be able to grow. I mean, I do feel that banks, they're all in this together to really take a hard line against who they lend to, how much money they lend, and that's to me one of the biggest factors right now as to why the economy's not growing. Okay, I feel like there's not enough access to capital to help companies grow, and that's not going to change. Okay, as long as interest rates stay low, we're not going to have an environment where it's very conducive to lend money.
Well, because people can't save money, and you really should be investing money from savings, not from money that they print out of thin air and just throw into the economy on a diluted basis.
We're coming up on a break, Lewis. When we come back, we're going to dive into this week's credit tip of the week. Stay right there when we come back.